We're starting to see, I think, a bit of a fragmentation or a dispersion in terms of where AI can be applied. So obviously we're all familiar with the LLMs and that new way of doing search, and I'm sure most people, we're seeing the inflection in terms of the numbers of people using ChatGPT. I know my use of AI has really just grown exponentially in the last 12 months, but it's those new areas where the AI can be applied as well. So obviously that huge focus in terms of AI in robotics, in terms of autonomy. I know every time I go to San Fran now, I jump in a Waymo, Tesla's trying to get their network up. And so it's more that dispersion in terms of where AI can be applied, I think, is where you're starting to see some real traction. I think the other piece that is somewhat underappreciated is that while there are the revenue opportunities that run off the back of AI, I think the cost savings can be significant. And for a demonstration of that, you just have to look at some of the big tech companies where they've gone through that period of employee explosion growth post-COVID. They went through their get fit period, but now you're actually seeing some employee numbers start to come off as they start to push AI through their businesses and start to get some real efficiencies come through. And I think that's the piece that's not spoken about as much. It is that pure efficiency and the cost saves from pushing AI through an existing business. You don't have to be a tech business. You can just be a standard S&P 500 or MSCI World business and start to see some real benefits come through from AI. And I think that's going to be a really big chunk of the returns that we can expect to see coming off the back of that AI infrastructure spend.
Trent, I'm curious how you think about it. I know you've been thinking about tech in China post, of course, the DeepSeek moment, right? There's been an explosion of AI there. But the business model is totally different, right? For China, these names are going to go for dominance, for control, for market share. They're not going to be worried about profits necessarily, not for a while yet. And, we've seen that play out in EVs as well. Whereas with the hyperscalers, they need to monetize and fast, right? After spending $300 billion. How do you think about it, and how do you play China AI? I mean, you've got obvious names like the internet platforms, the Alibabas of the world, but beyond that?
Yeah, no, look, and that's really interesting there, Martin, because I think, the US policy of trying to constrain China from an AI perspective, I think it might work for a while, but it's certainly not going to work forever. I think trying to constrain, 50% of all global STEM graduates coming out of China, there's always going to be a high degree of innovation that comes out of that industry. And I think we had a good example of that through DeepSeek, which was quite an effective model, but just caused a bit of a shockwave through markets in the first half of the year. Now, in terms of that, what I'm really interested in is seeing that next iteration in terms of DeepSeek, or seeing that R2 model come out, because there is some talk the lack of access to the NVIDIA H20s might be causing a few issues there. But I think that innovation will continue. And so for us, in terms of the investment in China, we do tend to be quite selective because we're always wary of potential governmental intervention. And so for us, it is more through those companies that can use the AI. And so for us, the standout in that Chinese market is Tencent, through their gaming platform, through the marketing and social media, driving a whole lot more engagement. They could potentially increase some ad load, and you've got that business services piece as well. So for us in China, it is more of a very kind of thoughtful way to play AI, and it's more primarily through the companies that can leverage AI to drive an inflection in their existing business.
Okay, understood. And can't leave off without talking about Europe. I mean, sounds like it's in a good place, right? I mean, fiscal taps on. Let's go credit. It sounds as though, you could basically throw a dart and not miss.
Yeah. Look, it does feel like there has been almost a psychological change in Europe. Like post the GFC, we went through almost 15 years of deleveraging. But now what we're seeing is almost like a mentality shift and looking to drive some growth again, whether that's through some of the defence spending, whether it's through some of the infrastructure spending. And so I think one area in particular, we have been adding to some of our European names. I think the banking sector there, you have a look at a bank like a CaixaBank, Spain's biggest lender. Because you've gone through that deleveraging, the credit books are very, very clean, and you're starting to see some loan growth return. So you've got to keep an eye on NIMs because of the competitive intensity, but you are starting to see that macro backdrop be really supportive, and something like a CaixaBank, I think, is really well placed to be able to benefit from that macro backdrop. Also within Europe, companies like AstraZeneca, I think that leading pharma company, it's got the best positioned late stage growth profile, I think, given their spend in terms of R&D, normally runs at about 20%, industry is normally about 15. And so there are some selective areas in Europe. While I do agree that Europe in general looks a lot better, and as a whole the region is going, there are some select areas, I think, where you can generate outsized returns by allocating capital in that way.